Welcome to Talk Tickers. I'm your host, and today we are going to bypass the flashy headlines to get straight into the plumbing of the financial world. Usually on this show, we talk about earnings calls and guidance and, the numbers that move markets right now. But today we are zooming out. We are going to take a deep dive into the invisible infrastructure that is fundamentally changing how money moves.
It is great to be here. And you are totally right. Usually when people talk about fintech, they think about a flashy app with a colorful debit card or maybe some crypto exchange. But the real story, the one that you as sophisticated investors and operators really need to understand, is happening completely underneath the surface. It is not the paint on the house. It is the foundation.
Exactly. We are talking about the mechanics and the market structure of embedded finance and banking as a service, or BOMPAS, as it is usually called. Now, before you tune out thinking this is just some dry back-end tech talk, let me give you the hook. This is the exact technology that allows a coffee shop app to hold more customer deposits than some mid-sized regional banks.
Which is still wild to think about, honestly.
It is crazy, and it is the reason your rideshare driver gets paid instantly after a trip rather than waiting 2 weeks for a direct deposit. It is a massive structural shift that basically allows non-financial brands to act exactly like banks.
And it is a massive shift financially, too. We aren't just talking about a minor convenience here for the user. We are talking about a total restructuring of the financial market. If you look at the projections, the global embedded finance market is estimated at around $111.7 billion in 2024.
Which is already a massive number.
It is huge. But if you look forward just 10 years to 2034, predictions sit at approximately $1.73 trillion.
Wait, let's just pause on that for a second. That is a jump from roughly $100 billion to nearly $2 trillion. That is a compound annual growth rate of over 31%. I mean, there are very few sectors in the entire global economy growing at that kind of pace.
Precisely. And the why behind it is what is so fascinating, because it is not just about letting you pay for things easily. It is a pure revenue multiplier for these companies. When a platform, let's say a SaaS company for yoga studios or a marketplace for freelancers, when they embed financiers, they aren't just processing payments.
Right. They are actually monetizing the transaction itself.
Exactly. They are increasing revenue per user by 2 to 5 times. They are seeing retention rates improve by 1.5 to 3 times. It literally turns a software company into a financial infrastructure company. And as we know, that does absolute wonders for valuation multiples.
So today we are going to tear this all apart for you. We are going to look at the mechanics, the difference between embedded finance and bias, because those aren't the same thing at all. We are going to get surprisingly technical on the architecture, how the APIs and microservices actually work to move this money in milliseconds. We will look at big players like Lyft and Starbucks. And then we really need to talk about the risks, because the regulators are definitely waking up and the landscape is getting incredibly tricky.
It really is. The regulatory minefield is probably the most critical topic for anyone looking to invest in or operate in this space right now. If you don't understand the liability side of this, you basically do not understand the business.
Okay, let's start at the top then. Let's define the ecosystem for everyone. We see these terms thrown around constantly. Embedded finance, API, banking, BaaS. Let's unpack the hierarchy. What is the actual structural distinction here?
Think of it simply as the what versus the how. Embedded finance is the what. It is the customer-facing product. When you are checking out on an e-commerce site and you see a buy now, pay later option, or when you get travel insurance offered directly inside a booking app right before you pay, that is embedded finance. It is the integration of financial services into a non-financial platform.
Right. So the user sees the financial product, but it feels native to the app they're already using. They don't feel like they have left their favorite shopping app to go log into a traditional bank portal.
Exactly. The user experience is totally seamless, but the gears turning in the back to make that happen, that is banking as a service. That is the how. BaaS is the model where licensed banks open up their core infrastructure via APIs to third parties. It is the digital pipe that connects the non-bank brand to the highly regulated banking system.
So if we visualize this as a tech stack or a 3-layer model, walk us through who sits where. Because it's not just the app on one side and the bank on the other, right? There is a critical middleman.
Right. It's almost always a 3-layer cake. At the very top, you have the end brand. In the industry, this is often called the program. This is the user-facing entity. Think Shopify or Uber or your favorite airline. They own the customer relationship. They have all the behavioral data. They know that you, the user, need a loan right now because you are buying inventory, or you need insurance because you just booked a flight to Europe.
They are the ones leveraging that incredibly rich contextual data to offer the product at the absolute perfect moment. But they aren't banks. They don't have a banking charter.
Correct. They are absolutely not banks. So they need the next layer down, which is the boss provider or the enabler. These are the middleware tech companies. Examples would be Marqeta or FIS or Stripe. They provide the technical layer, the APIs, the dashboards, the white labeled user interfaces. They essentially translate the modern agile code of the tech company into the legacy language of the bank.
Okay, so the brand talks to the middleware. But the middleware isn't holding the money technically either. They aren't the vault.
No, they are just the translator.
Mm-hmm.
That brings us to the bottom layer, which is the bedrock, the sponsor bank. This is the license holder. These are the regulated entities. Often they are regional banks in the US or electronic money institutions in Europe. They actually hold the charter. They connect to the real payment rails like Fedwire or ACH or SEPA. And crucially, they bear the ultimate regulatory liability.
That is a critical distinction for you to grasp.
Yeah.
Even if a flashy startup is the face of the debit card, if things go south, the sponsor bank is the one the federal regulators are going to call.
That is exactly right. And that relationship between the three layers can work in a few different operational ways. We generally see three models, and this is where the risk management gets nuanced. The first is bank as a regulator. In this model, the sponsor bank is very hands-on. They closely monitor all controls. The fintech partner might take on some risk management as they mature, but the bank is watching them like a hawk.
Which sounds like the safest way to do it from a compliance standpoint, but probably the slowest for product development. If I am a startup trying to move fast, I do not want a compliance officer from a regional bank looking over my shoulder every 5 minutes.
It is definitely slower, but it is sustainable long-term. Then you have the program management model. Here, the bank outsources a massive chunk of the risk and governance to that middleware platform we talked about. The bank remains somewhat hands-off. They basically collect a fee for renting out their charter. This is where we've seen some massive friction recently because regulators are stepping in and asking the banks if they actually know what their partners are doing.
It sounds like absentee landlording, like saying I own the apartment building, but I have zero idea who is living in the units or what they are doing in there.
That is a very apt analogy. And the regulators hate that. The third model is compliance as a service. In this scenario, the fintech uses the bank's existing compliance infrastructure entirely. The bank controls everything. The KYC, the anti-money laundering, checks the transaction monitoring. The fintech is really just a marketing wrapper sitting on top of the bank's processes. It is the fastest way to market, but offers the absolute least flexibility for the brand.
So we have the players on the field defined. Now, I really want to get into the engine room. How does this actually work technically? Because we aren't talking about old school banking mainframes here where a guy in a suit is stamping papers. We are talking about cutting edge tech stacks. If I swipe a card issued by a ride sharing app, what is actually happening in those milliseconds?
This is where it gets really interesting for the tech savvy investors out there. The shift here is from legacy monolithic banking systems, those giant slow mainframes that maybe update their ledgers once a day, to cloud-native microservices. We're talking about distributed systems deployed on Kubernetes containers.
And the heartbeat of this new system is often something called event-driven architecture. Why is that specific architecture so important for modern finance?
Because finance historically was always batch processed. Think about how a traditional bank operates. You buy a coffee at 2 p.m. The bank does not really settle that transaction instantly. It just goes into a holding bucket. Then overnight, the massive mainframe wakes up, runs a giant batch process, and updates everyone's ledger all at once.
Right. That is why sometimes you log into your app and see pending on your statement for 2 straight days.
Exactly. In an embedded world, that simply does not work. If you are offering a point-of-sale loan, or if you are authorizing a gig worker's payout instantly, you need to know right now if the customer is eligible. You cannot wait for the nightly batch process to tell you they overdrew their account yesterday.
So enter Apache Kafka.
Exactly. Apache Kafka acts as the event backbone. Imagine a central nervous system for the bank. Every single transaction, every login, every data update is an event that gets published to this continuous log. It enables real-time processing. Eligibility updates and offer adjustments literally happen in milliseconds.
So instead of one giant database updating once a night, you have a continuous stream of events that dozens of different microservices can listen to and react to instantly.
Yes, and it has incredible resilience, which is huge. It provides fault isolation. Because it is microservices based, let's say the lending offer service crashes due to a bug. In an old monolith, the whole bank goes down. No one can log in. In this modern architecture, the payment processing service keeps running perfectly fine because it is a separate container just listening to the Kafka stream. The whole bank doesn't go down just because one single feature glitched. That is vital when you're processing millions of transactions globally.
Let's talk about the API layer. This is the digital door that the BOSS provider opens for the brand to use. What are the key capabilities passing through that door? What are these developers actually building into their apps?
You basically have an API gateway that manages all the complex authentication using modern web standards like OAuth 2.0 and OpenID Connect. But functionally, you have three main buckets of APIs. First, you have payment APIs. This allows the brand to trigger ACH transfers, which usually take a day or two, or wires, or increasingly real-time payments, or FedNow.
FedNow being the new instant payment rail from the U.S. government.
Yes, base providers are actually the primary way non-banks are accessing the FedNow rails today. Then your second bucket is account APIs. This enables the creation of virtual accounts. This is an absolute game changer specifically for B2B operations.
I want to break down virtual accounts because it sounds counterintuitive. Is a virtual account like a fake account?
Not fake at all, just virtualized. Imagine you were a large property management software company. You have one real master bank account at your sponsor bank. But through the API, you can instantly issue a unique virtual account number to every single tenant you have across thousands of buildings. When a tenant pays rent to their unique routing and account number, the money actually lands in your master account, but the banking system automatically tags it and says this specific dollar amount came from tenant A in building 4.
So it completely solves the accounting reconciliation nightmare. You no longer have to look at a spreadsheet of deposits and guess who sent you $500 on Tuesday.
Yeah.
Exactly. It routes payments to a master account while perfectly tracking transaction level data. It is fully automated accounting. It saves thousands of hours.
And the third API bucket.
Card issuance. Issuing both virtual and physical debit or credit cards. And doing it with modern tokenization so the actual 16-digit card number is never exposed during the actual transactions.
I want to zoom in on something you mentioned earlier because I think it is the secret sauce here. Real-time risk assessment. Because if a coffee shop or a software platform is acting like a bank, how on earth do they know who to lend money to? They do not have 100 years of credit history on their customers like JP Morgan does.
This is exactly where the technology outpaces traditional banking. Traditional banks rely heavily on the FICO score, which if you think about it is a deeply backward-looking metric. It just asks, did you pay your credit card bill 3 years ago? Embedded finance moved completely beyond the credit score to real-time algorithmic evaluation.
What does that mean practically, though? What actual data are they feeding into these algorithms? They take inputs that a traditional bank loan officer would literally never see. If you are an Amazon seller or a Shopify merchant, the platform sees your minute-by-minute sales history. They see your exact return rates. They see your customer review ratings. They know if your business is healthy today, right at this exact second. They combine that proprietary platform data with live bank data pulled via aggregators like Plaid.
So they are building a real-time living health score of the business rather than looking at a tax return from last year.
Yes. They use machine learning models. Specifically, gradient boosting algorithms are very popular right now in this space to predict default risk.
Yeah.
And here's the absolute kicker. Because they process all this instantly, they can do dynamic offers.
Dynamic offers. Walk me through what a dynamic offer actually looks like for a business owner.
A traditional bank gives you a static line of credit. They say, here is $10,000 at 8% interest. See you in a year. An embedded finance platform can modify your loan terms instantly. Your interest rate, your maximum loan amount can change in real time based on your sales from yesterday. If your sales spike, your credit limit goes up instantly so you can buy more inventory. If your customer returns spike, the algorithm tightens your credit instantly to reduce risk. Traditional banks simply do not have the infrastructure to do that.
That is incredibly powerful. The credit facility literally breathes with the natural rhythm of the business. But with all this proprietary data moving around, sales data, bank data, personal info, security has to be an absolute nightmare. We are talking about personally identifiable information flying across millions of API calls every second.
It is the top priority for these engineers.
Yeah.
The entire infrastructure relies on heavy encryption. They use TLS 1.3 for data in transit with perfect forward secrecy. But for the really sensitive stuff like the actual cryptographic keys that sign the financial transactions, they use HSM's hardware security modules.
HSM sounds like something out of a spy movie, to be honest. What actually is an HSM?
It kind of is like a spy movie. These are physical hardware computing devices. They are FIPS 140-2 Level 3 validated. Their only job is to manage cryptographic keys. The keys literally never exist in unprotected software memory. And here is the crazy part. If a bad actor tries to physically tamper with the hardware in the server farm, like if they try to drill into the server chassis or change the electrical voltage to glitch the processor, the device detects the physical intrusion and instantly wipes all the cryptographic keys.
So it literally self-destructs the banking data if someone tries to physically hack the hardware.
Precisely. It turns into a brick.
Yeah.
That is a level of military-grade security required by regulators to link into the national banking rails.
Okay, so the tech is incredibly robust. Now let's see it in the wild so you can visualize this. We mentioned the why earlier, revenue and retention. Let's look at a prime example in consumer mobility, specifically Lyft.
Lyft is a classic case study in how to do this right. They launched Lyft Direct. It is a fully functional business debit card and bank account setup built specifically for their drivers. Now, why would a rideshare software company want to do that?
Well, the obvious pain point for gig drivers is cash flow. You drive all week, you burn a tank of gas today, but you traditionally don't get paid until the direct deposit hits next week. It is a massive liquidity gap for the worker.
Exactly. The core value prop for the driver is instant payouts. You drop off a passenger at the airport and boom, the money's in your checking account before you even pull out of the terminal. No weekly delays. But for Lyft, the revenue model behind this is pure genius. They actually do not charge the driver a payout fee for this instant transfer.
So where's the monetization for Lyft if they aren't charging a fee?
Interchange fees. When the driver takes that Lyft Direct debit card to the gas station or the grocery store, Lyft earns a percentage slice of that swipe fee from the merchant. And to highly encourage that specific behavior, Lyft offers the driver cashback rewards on gas and groceries, but only if they use the Lyft Direct card.
So they're essentially trapping the money inside their own ecosystem.
They keep the driver spending within the ecosystem. And they do have a feature called Express Pay, where a driver can choose to cash out instantly to an external debit card, like say their personal Wells Fargo card. But that costs a fee usually around $1.75. By offering the banking product natively, they transform a gig platform into a sticky neobank.
That is the retention piece we talked about. If I'm a gig worker and I can get paid instantly for free on Lyft, but I have to pay a fee or wait a week on Uber, I am absolutely driving for Lyft on a Tuesday night when I need grocery money.
Exactly. It becomes a powerful competitive moat for labor supply, which is everything in the mobility space.
Let's look at retail loyalty next. This is the big one everyone always talks about, Starbucks. I have heard financial analysts joke that Starbucks is just an unregulated bank that happens to sell coffee on the side.
It is not really a joke. It is statistically accurate at this point. Starbucks Rewards members drive 55% of their entire U.S. operating revenue. That is a staggering metric for a food and beverage company.
And they hold a massive amount of customer deposits, right? Sitting in those stored value digital cards.
Billions of dollars. It is essentially a massive interest-free loan from the American consumer directly to Starbucks. But the evolution of their strategy is what really matters here. They went from physical stored value cards back in 2001 to the highly integrated mobile app in 2009. And now they are pushing heavily into Web3 with a program called Starbucks Odyssey.
What is the actual goal with Odyssey, though? Is it just corporate crypto hype?
It is an extension into NFTs and digital collectibles to fundamentally deepen customer engagement. They call these interactions journeys. The strategy isn't just buy a coffee and get a star anymore. It is maximizing behavioral personalization. Starbucks essentially wants to outpace traditional banks in the depth of their customer relationships.
Because a bank just looks at my credit card statement and knows I spent $5.40 at Starbucks, but Starbucks knows exactly what I bought.
Right. They know you bought a venti oat milk latte at exactly 8:02 a.m. They know you usually buy a butter croissant on Fridays, but only when it's raining. They can personalize the financial offer, the reward, the incentives, in a granular way a bank never could. A bank just sees a generic transaction ledger. Starbucks sees a complete consumer lifestyle.
Let's pivot to B2B, because it is way less flashy than NFTs, but potentially vastly more lucrative. Accounts payable and receivable. This is the boring back-office plumbing that literally runs the global economy.
This is all about pure operational efficiency. Integrating modern banking APIs directly into corporate invoice processing reduces processing time by up to 75% and reduces operational costs by 70%.
How does it actually save that much time and money? What is the mechanism?
Automated reconciliation. It goes back to those virtual account numbers we discussed earlier. If every single outgoing invoice has a unique virtual routing number attached to it, When the client's payment finally lands, the software knows instantly and perfectly exactly which invoice to mark as paid. No human accountant ever has to look at a spreadsheet and cross-reference payment amounts.
And it probably helps with routing the outbound payments too, right?
Huge help. It allows for incredibly smart payment routing. The software can automatically decide based on parameters.
Yeah.
You can say, do I pay this specific vendor via a standard ACH because I have 3 days before the deadline? Or do I route this payment via the real-time payment network right now because I need these raw materials released from the warehouse today? It optimizes cash flow visibility perfectly. It is absolute operational magic for a CFO.
So the value proposition is crystal clear. If you are a company wanting to do this, who do you actually call? Let's survey the landscape of providers because it seems heavily split by global geography.
It really is.
Yeah.
The regulatory environments in Europe and the United States are fundamentally different, and it completely shapes the market structure and who the dominant players are.
Let's start with the European landscape.
In Europe, you have a very clear legal distinction between an EMI, which stands for Electronic Money Institution, and a full bank license, an EMI. These are companies like ConnectPay or Railsers. They can legally issue e-money and process digital payments, but they are strictly forbidden from lending money from their own balance sheet.
So they are purely money movers, not money lenders.
Correct. They are fantastic for operational flexibility and getting a payment product to market fast. But if your brand needs to actually hold customer deposits or offer lending products, you must partner with a provider that has a full banking license.
Like Solaris.
Exactly. Solaris is a massive player in Europe. They are known for being highly enterprise grade, but with that comes higher technical complexity. You go to them when you want to build a very serious regulated banking product. Clearbank in the UK is another fascinating one. They're unique because they are a clearing bank. They have direct technological access to the UK payment rails like Faster Payments and ChapEOS. They do not have to rely on another legacy bank to actually move the money for them.
And what about Banking Circle?
They are highly specialized. They focus entirely on cross-border payments and SWIFT integrations. They provide the core infrastructure for other payment service providers. If your platform is moving money across international borders in multiple currencies, they are an incredibly strong specialist to look at.
Now, over in the United States, we don't really have this EMI concept at the federal level. We have the sponsor bank model we talked about. Who are the middleware players connecting software companies to those regional banks?
You have platforms like Unit, which is incredibly popular with early stage startups right now. They focus intensely on developer-friendly APIs, and they have already built the tedious partnerships with FDIC-insured banks. They actively try to abstract all the banking complexity away so your engineers can just focus on building a great user interface.
Then there is Treasury Prime. How do they differ?
Treasury Prime is also API first, but their philosophy is different. They connect fintechs directly with the licensed banks. There is far less abstraction layer. You as the brand have much more technical control, but you're closer to the metal, so to speak. You maintain a direct relationship with a sponsor bank, which a lot of mature companies prefer for long-term stability.
And Stripe obviously has a huge footprint here.
Stripe Treasury, yes. If your platform is already deeply embedded in the Stripe ecosystem for your regular checkout payments, it is absolute the path of least resistance. It is highly integrated and seamless, but you are tightly coupled to Stripe's overall architecture. You are playing strictly in their sandbox and subject to their platform rules.
Okay, this all sounds fantastic so far. Unprecedented revenue growth, massive operational efficiency, perfectly sticky customers. But we have to talk about the dark side of this revolution. The risks. Because the federal regulators are definitely not ignoring this Wild West anymore.
No, the Wild West days are officially ending. Regulators have clearly noticed that unregulated third parties are performing core banking activities. The single statistic you need to internalize is this. Sponsor banks are 9 times more likely to receive severe regulatory enforcement actions than standard non-partner banks.
9 times more likely. That is a massive flashing target on their back. That suggests to me that these complex partnerships are inherently riskier, or at the very least, way harder to manage effectively.
It is absolutely both. Regulators like the FDIC and the OCC are scrutinizing these third-party vendor relationships heavily. They are aggressively forcing the sponsor banks to increase their direct supervision. It is simply no longer legally acceptable for a bank president to say, oh, our fintech partner handles all the compliance checks. The charter holding bank is strictly liable, period.
We actually have a 5-point risk framework from the research that really breaks this liability down. I want to walk through these one by one, because if you are an investor allocating capital in this space, these are the exact landmines that will blow up a portfolio. First up is interoperability.
This is primarily the technical risk vector. You are connecting disparate APIs, microservices, and private corporate clouds across multiple different corporate entities. If a critical data link breaks, who is legally responsible to fix it? Incident response becomes infinitely harder when your core systems are distributed physically across 3 different organizations in different time zones.
Second on the framework is data containment.
This asks the question, who actually owns the consumer data? You have the end brand, the middleware provider, and the sponsor bank. The highly sensitive personal data is shared horizontally across this entire ecosystem. Privacy risks skyrocket exponentially. If there is a massive data breach, where exactly did it happen? Who reports it? And more importantly, do you actually have the end user's explicit legal consent to share their financial data all the way down the vendor chain?
Third is complex partnerships.
In risk management, we call these 4th and 5th party relationships. Your immediate vendor relies on another vendor who relies on a cloud hosting vendor. It shifts the entire dynamic from simple linear liability management to what is being called entrepreneurial partnership. And that creates massive internal friction. If the startup fintech wants to launch a highly risky lending product to hit their quarterly growth targets and the traditional bank says absolutely not to protect its charter, you have a fundamental conflict of interest.
Fourth is vulnerable customers. And honestly, this one feels ethically very heavy.
It is incredibly heavy. The core question is, who owns the legal and ethical duty of care? If a slick buy now, pay later app uses aggressive push notifications to incentivize a financially vulnerable customer to spend way beyond their means, is the sponsor bank legally responsible for that predatory behavior? There are massive regulatory concerns right now about behavioral data harvesting and predatory lending practices hiding behind friendly, colorful software interfaces. The federal regulator looks directly at the bank and says, you provided the capital that allowed this to happen.
And finally, the 5th point is distributed risk.
This introduces the concept of breakout fraud. Imagine a sophisticated synthetic fraud attack hits the software end brand. The brand itself might easily absorb the actual financial loss from their balance sheet. But the sponsor bank is the one that risks the severe reputational damage and the multi-million-dollar regulatory fines for failing to catch it. Suspicious activity report volumes, SARS. They are growing at 31% year over year. The compliance teams at these regional banks are literally drowning in automated fraud alerts generated by their fast-moving tech partners.
And the specific nature of the threat is evolving rapidly too, right? Mobile fraud specifically seems to be the weak point.
Mobile fraud grew 7% globally between 2024 and 2025 alone. And the primary weak link they're exploiting is knowledge-based authentication, or KBA.
Just to clarify, KBA, those are the security questions like, what is your mother's maiden name, or what street did you grow up on?
Exactly. In the modern age of massive global data breaches, all of that personal info is readily available on the public internet or the dark web. Using KBA for securing a bank account today is literally like locking your front door with a piece of string. It provides zero actual friction against automated attacks.
So for the operators and investors listening to this right now, how do you actually navigate this minefield? What is the smartest strategic play? Because if the regulatory risk is this high, is the revenue even worth it?
It ultimately comes down to time to market economics. If you, as a software platform, try to build a direct bank integration completely yourself without using a BaaS provider, you are looking at 12 to 18 months of incredibly high complexity engineering work. You need to hire a massive, expensive team of specialized banking engineers.
Versus using an established platform.
Right. If you use a full stack BaaS platform, you can cut that launch time down to 2 to 3 months. If you use simple, highly abstracted embedded finance APIs, you can literally be live in 4 to 12 weeks. And as we know, speed is absolute money in the startup world.
But look at it from the other side. Why are the traditional regional banks even agreeing to do this if the regulatory risk of massive fines is so incredibly high? Why take the regulatory bullet for a Silicon Valley startup?
Access to cheap deposits. That is the absolute holy grail for a regional bank. Acquiring a net new retail customer for a traditional brick and mortar bank costs them anywhere between $100 and $200 in marketing and overhead. Through a BaaS partnership where the startup does all the marketing, the bank's customer acquisition cost drops to between $5 and $35.
Wow. From $200 down to $5, that is an absolutely incredible structural arbitrage for the bank.
Exactly. It brings in massive waves of incredibly cheap deposits they can lend against. And strategically, it helps these banks transition away from volatile interest income, which fluctuates wildly with the Fed rates, to highly stable fee income generated purely from digital interchange volume.
And for the tech platforms jumping in, it's all about that valuation multiple.
Absolutely. A pure software tech company trades at a vastly higher multiple than a regulated financial services company. If you can successfully layer high-margin, sticky financial revenue on top of your existing software platform, the public markets and private investors absolutely love it. You get the premium valuation of an agile software company combined with the aggressive monetization engine of a bank.
Looking ahead to the horizon, what are the underlying technical trends worth watching over the next few years? What is next for the actual plumbing of this ecosystem?
Blockchain integration is absolutely coming for the back office. Now, I am not talking about retail crypto speculation. I'm talking about using distributed ledgers for immutable transparency in compliance documentation and regulatory audit trails. Having a shared cryptographic ledger between the bank and the tech platform makes regulatory reconciliation infinitely easier and more secure.
And what about edge computing? I see that mentioned in the technical roadmaps.
Edge computing is going to be critical purely for processing speed. It involves moving the complex algorithmic eligibility verification to the edge of the network, meaning processing the data physically closer to the user's mobile device to radically reduce network latency. If you're doing instantaneous point-of-sale lending at a physical checkout counter, every single millisecond counts. You literally cannot have the customer awkwardly waiting 5 seconds for a server in Virginia to approve their loan while they stand at the register. It needs to feel instantaneous to maintain the illusion.
So to properly wrap this all up, embedded finance is really the ultimate convergence of software and traditional banking. It fundamentally moves banking from being a destination, a physical place, or a specific portal you have to go to into just being a feature, something that seamlessly happens exactly when you need it within the context of what you were already doing.
That is a perfect summary. But to actually survive and scale, it requires an incredibly sophisticated modern tech stack. The Kafka streams the Kubernetes, clusters the microservices. And equally important, a deeply robust risk framework. You simply cannot just slap a startup logo on a white-labeled debit card and hope the regulators don't notice you anymore. The free ride of the early fintech boom is completely over.
Which brings us to the one question. If you are an investor looking at a fast-growing software platform today, or you are an operator thinking about partnering to launch a financial product, what is the single most important question you need to ask to cut through all the marketing noise?
The defining question is this. Does the platform own the compliance workflow, or are they simply renting the rails?
And why does that specific operational distinction dictate the future of the company?
Because in this rapidly tightening federal regulatory environment, platforms that rely entirely on absentee third parties for their compliance checks are essentially ticking time bombs for enforcement actions. They are literally one rigorous OCC audit away from having their partner bank shut off their API access overnight. While the companies that have built embedded compliance infrastructure, the ones who treat regulatory adherence as a core engineering product feature rather than an afterthought, those are the platforms truly built for longevity and massive scale.
So if they do not own the compliance, they do not own their future. But it makes you wonder what happens to the broader economy when one of these massive non-bank platforms inevitably fails and takes millions of uninsured consumer deposits down with it because of a desynced ledger. That is a systemic risk we haven't even fully priced in yet. Something to think about. That is it for our deep dive into the hidden plumbing of modern finance. Thanks for listening to Talk Tickers.
Thanks for having me.